All right, it is Wednesday, and you know what that means? It's another edition of there it is. Taxes and Retirement Live. I am Andy Panko, owner of Tenant Financial, admin and moderator of Taxes and Retirement within Facebook, and tonight's host for the discussion, which will be about mutual funds versus exchange traded funds, or ETFs. I know I labeled tonight's topic as pros and cons of mutual funds versus ETFs. I'm going to kind of approach it as more of a compare contrast between the two, and then in doing so, we'll mention when it makes sense to potentially consider using this option versus that option type thing. Before we start, and next week actually is going to be, I believe, another open mailbag session, but more importantly, that will be the 1-year birthday / anniversary of me doing these Taxes and Retirement Live things. I started it Wednesday night a year ago, middle of June. So excited that it's gone a full year already, and have consistently did this every week with the exception of the last 2 weeks of December. Took those off to kind of recharge, give everyone a break, and then start it up again. So anyway, next week will be a good one. Maybe I'll get a birthday hat or something for the 1 year / birthday anniversary of these weekly Taxes and Retirement Lives. All right, let me start you with the dad jokes. All right, so first one: how does a demon stay fit? He exorcises. Does like demon squats and demon deadlifts and stuff, and demon cardio. All right, next, I watched a documentary about hydroelectricity last night. It was the best damn movie I've seen in a while. Get it? Hydroelectricity, water falling down, spins the turbine, creates electric. It's some fancy scientific stuff. And finally, scientists have discovered a new and very dangerous virus named Peekaboo. Anyone who has it is immediately sent to the ICU. That kid thinks this joke is awesome because it is. Cool. So before we get going, let me just hit you with the disclaimer here. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I'm just some guy talking about mutual funds and exchange traded funds here on Facebook Live tonight. Okay. Cody informed me that there appears to be some Facebook outages or issues tonight. Hopefully you all see this. Let me just go over to Facebook quick. The feedback from Cody was that he can see this on his phone, but not his computer. So I do see it. I'm on my computer. I can see it here. Anyway, so some of you may or may not be able to see this tonight. Don't worry. As always, the replay will be saved up, posted in the group, and then also posted in on my YouTube channel for everyone to view it there. So yeah, see, there's only 32 sets of eyes watching right now, which is a lot lower than normal. So I guess people are having difficulties. Okay, so yeah, some people can see it on iPad, iPhone. All right, good enough. Well, let's get going then. So I have a screen share tonight, which just was kind of, to be honest, stole this from a presentation or a YouTube video I made, I don't even know, some point in a year or so, roughly, about mutual funds versus exchange traded funds. So let me pull that up. Share. There we go. Okay. So I want to first start, and as always, or as I've been doing, let me kind of run through my bit here, and then happy to take whatever questions at the end, just so I don't break up the flow of this presentation too much. So let me start by saying, what is a pooled investment vehicle? Why is this important? Because a mutual fund, an exchange traded fund, or ETF, and other funds like it, all work are all basically this pooled investment concept. And here's what I mean by that. So let's assume here's the S&P 500. You all know what a stock is, presumably, maybe a bond as well. Not important for tonight's, but just let's assume individual investments, individual stocks. If you wanted to buy or get yourself exposure to the S&P 500, which is the 500 largest companies whose shares are traded on U.S. exchanges, it would be this much money, let's say, this big green blob here. If you were to buy, one of every single share or whatever, not entirely accurate. If you wanted to replicate the index, that's not what you would do. But let's just assume, if you were to buy all of the 500 stocks in the S&P, it would take you this much money because it's 500 stocks. Well, what if you only had this much money to actually invest? $1,000, let's say, right? This $1,000 unfortunately cannot buy you all 500 shares, all 500 companies in the S&P 500, because like Amazon alone is well over $3,000, right? So your $1,000 isn't going to buy you one share of Amazon, let alone all 500 companies in the S&P 500. But what if you and a bunch of other people like you all took your $1,000 and you all collectively wanted to buy the S&P 500 or exposure to the S&P 500? So you decided you all take your $1,000, you pull it up, and you now have this big orange kind of oval thing here. This big pot of money pooled up now is large enough for that pot, that collective pot, to go and buy all the 500 shares in the S&P in the proper weightings and allocations to actually replicate the index as much as possible. So then all of these, however many people this is, whether it's hundreds or thousands or millions perhaps, they all put their money into this pool. This pool owns the stocks or the bonds or whatever the fund holds. And then all these individual investors who own a share of that pool literally own that. They own a prorated slice of that entire pot, such that everything that pot or that pool owns, all these individual fund owners own in their own respective portions based on how much money they put in relative to the whole pot. So that's a pooled investment vehicle. Super powerful, super efficient and good and easy to get diversification. So for example, like I said, it's not practical for you to buy all 500 stocks in the S&P 500. And even if you could, you'd have to rebalance and trade them in and out every so often to keep your exposure similar to what the actual index is. Whereas with this pooled investment vehicle, you can buy simply one fund, one transaction. You can buy a mutual fund or an exchange traded fund that invests in all the stocks of the S&P 500. So much simpler and easier way to get a lot of underlying exposure really cost effectively and efficiently by buying into a pooled investment vehicle like a mutual fund or an exchange traded fund. Okay, so that is the basics of a pooled investment vehicle. Now there's multiple types. The main one, the biggest one that most people know of is a mutual fund. The other increasingly common one is an ETF or exchange traded fund. And there's other sort of lesser known, lesser used types like closed-end funds or CEFs. There's interval funds. There's REITs, real estate investment trusts, which aren't really mutual funds or ETFs. They kind of look and act like them, but they're not. So I won't touch on those. I'm just discussing basic mutual funds versus basic exchange traded funds. So let's get into it. Like I said, I'm going to do a compare and contrast style table, and along the way, throw in kind of pros and cons of each, as it makes sense. So let's start with investment strategies. So mutual funds can be either active or passively managed. So what's that mean? You're all probably aware. You all seem to be, very well educated DIYers when it comes to this stuff, but I'll go through it nonetheless. So an active management or active portfolio is you buy into this mutual fund, you put your money in that pot, into that pooled investment pot. And then there's fund managers who work for the fund company, whose job it is to take that pot of money and try to go buy and sell individual securities that they think are going to do better than some index or, whatever their stated strategy is. So it might be like large cap US growth companies. Large cap just means the largest companies, largest what's called market capitalization size, the largest companies that are traded US, and growth versus value means those that, we'll get to in the technical matters, but those that are typically larger, established, or selling at a discount type companies versus those who are selling at a premium because there's anticipation of lots of growth to happen for them. Regardless, the point is the managers in this will actively go and try to find companies they think are going to do better than other ones. They'll buy the ones they think will do better. They'll not buy the ones they think are going to do relatively poorer, and hope that all in their collection of picks does really well. And it's active because they will monitor these companies, and if and when something changes, like bad news or earnings come out that may change the fund manager's view or thesis about the companies, so they may then sell out of it. And then, buy into a different company instead. So that's active. It's fairly hands-on, a lot of research, a lot of, resources and personnel hours to do this. Versus passive. Passive is simply the fund's intention is just to replicate an index as much as possible, like the S&P 500. Again, S&P 500 is the 500 largest companies whose shares are traded on U.S. exchanges. It is what it is. The index is published by Standard & Poor's. It's tweaked or rebalanced every quarter, I believe. And so you can't directly invest in an index. An index is just simply a hypothetical reference. It'll be like, the S&P 500 is literally just that. It's the 500 companies put together in a certain weighting, but you can't directly invest in that index. You can invest in a fund who tries to replicate that index as closely as possible. That's what mutual funds and ETFs do. So you can buy a passively managed fund where its strategy, its goal is simply to try to invest in all the companies that the S&P 500 index tracks and rebalance accordingly, so your returns of the fund are as close to the returns of the index as possible. So that's passive. It's much more hands-off. It's kind of a set it and forget it. Whatever stocks are in the index, that's what stocks this fund is going to hold, right? No more, no less. Whereas active management, the manager has full discretion to kind of buy and sell what he or her chooses. So that's active versus passive. ETFs, in mutual funds, you can have both flavors. Historically, most were active. Passive is increasingly common and has been for the better part of 20 years and continuing to gain momentum, passive versus active. ETFs historically have been virtually all passive, but there is some active and a growing number of actively managed ETFs with actively managed strategies. There's a few reasons for that. I won't get too much in the detail, but just know that generally speaking, ETFs have historically been just an index tracking fund or like a sector focused fund or something broad in general. It's not really like an actively traded. The manager goes and tries to pick the best bets he or she thinks are going to do well. But there are some actives nonetheless. All right, next, fees. Difference in fees between mutual funds and ETFs. So there's some things that are common, some things that are different. And just going back to investment strategies quickly. So for passive, for example, you can buy, there's a whole host of funds out there that will try to track the S&P 500, for example. You can buy in mutual fund form, you can buy in ETF form, and there's dozens of different fund managers that all have an S&P tracking product. So across all those, they're virtually identical funds. The fees are going to be the only real differences, and maybe to some extent how often they rebalance or how close they try to track the index. But for the most part, generally speaking, an S&P mutual fund is going to be almost identical to an S&P ETF in terms of how it's ultimately going to perform, where the fees are the only real difference between the two. So let's talk about fees. So with mutual funds, they all have something called an expense ratio. Not to get too technical about it, but expense ratio, you as the mutual fund owner, it's not something you explicitly pay. Like you don't have to write a separate check to the mutual fund company to pay them. Instead, that their fees, they just simply deduct from the value of your fund holdings. And that the amount they deduct is called an expense ratio, and it's quoted as a percentage. So a fund with an expense ratio of 1.00% simply means that every year the fund company, like I'm going to use Vanguard as an example, you buy a fund from Vanguard, there's costs associated with Vanguard running your fund, right? There's people they have to employ, there's buildings and overheads, there's regulatory requirements, there's reporting they have to do. That all costs money. So they should be compensated for it. So mutual funds are paid. The fee you pay is by an expense ratio, which using the example of 1%. If you put $100 into a mutual fund, the value of it's going to go up or go down based on what it's invested in, but also at the end of the year or throughout the course of the year, the fund company will take out $1 or 1% of your $100 as their fee. That's the expense ratio. The expense ratio can go, there's a few different fees that are rolled up into that expense ratio. There's what's called the management fee. That's literally like the overhead and the wages of the company and the people at Vanguard, in our example, who are doing the investing and transacting the buys and the sells and the trades and stuff like that. That's the management fee. 12B1 fee. This one's goofy and it's slowly going away. It's basically, there's a few things that can be rolled up into it. It's kind of murky, but it's in effect like I forget what they call it. It's an advertising and marketing fee or distribution fee also. It can do a lot of things. It's in essence pays for the fund, or it compensates the fund company for their efforts in distributing and marketing the fund. So when you buy this fund that has a 12b1 fee wrapped up into the expense ratio that you're paying, you're in effect paying for the fund company to reimburse them or pay them for the marketing they did to you for you to buy the fund, or to the distribution that they paid to some wholesaler who sold the fund to you. Anyway, so that's 12b1 fee. For what it's worth, a lot of brokers, typically the larger wirehouses, Ameriprise, Raymond James, I'm not picking on any in particular, but Merrill Lynch, the big traditional brokers, household name brokers we all have heard of, sometimes when they recommend you buy a certain fund, mutual fund, they may indirectly be getting a cut of that expense ratio by way of the 12b1 fee, because part of that 12b1 fee may be compensating them. The fund company may be compensating Merrill, for example, for Merrill recommending you buy this particular fund. So Merrill may get a cut, or any broker, not just Merrill, but fill in the blank of broker name, may get a little cut on the back end of the expense ratio you're paying to own that fund. And then there's other quote unquote other expenses. That could all depend what they are. Some funds have them, some funds don't. It's basically anything else that doesn't fall under management fee or 12b1 fee. Now, another thing that mutual funds may have is what's called a sales load, which is in effect a commission. Thankfully, most mutual funds now don't have loads. There are still some that do, and I think it's absolutely insane that there are, or at least people still buy funds that have a load when there's so many what's called no load options out there, meaning funds that have no upfront or back end sales charge or commission to buy. But nonetheless, some still exist. And I've seen one not too long ago that had a 5% sales load and like a 1.5% expense ratio, which is just, there's absolutely zero reason for it, yet people still buy it. And it made me angry. But an example of a sales load is like a 5% upfront sales load simply means if you you have $100, you want to invest in a mutual fund that has a 5% upfront sales load. The broker who sells you that fund will get a $5 commission, 5% of your $100 purchase, such that $5 commission is paid by you. So only $95 of your 100 actually goes into buying your investment, into buying your fund. The other 5 is a commission you paid to the broker who sold you the fund. These were common 20 plus years ago. Now, not so much. There are still loaded funds out there, but like I said, I don't really see any reason or any fund that's so special that it justifies paying a 5% sales load. It's just silly. Some have the sales load at the end. You don't pay any commission up front, but if you sell out of the fund within a certain amount of time, then you get hit on the back end with a sales load that they will take out of your sales proceeds. So that's front end versus back end load. ETFs do not have any sales loads. You'll notice that they do have expense ratios, as they should, again, because there's work involved in the fund company. Let's use Vanguard again, creating, managing, reporting on, trading this exchange traded fund. So ETFs have expense ratios just like mutual funds do. And again, expense ratios are built-in inherent fees that you indirectly pay by the fund company taking those fees out of your account value every year. You don't separately write a check for it. But anyway, ETFs have expense ratios just like mutual funds do. And it includes for ETFs the management fees and potentially other expenses. You'll notice there are no 12b1 fees associated with exchange traded funds. That's largely because there isn't like this network of wholesalers and brokers who try to sell you or distribute or promote mutual fund ABC versus XYZ. No, they don't have that. So ETFs don't have that built-in sort of advertising and distribution expense like mutual funds do with the 12b1 fee. So now, generally speaking, ETFs almost always have fees pound for pound, comparable ETF versus mutual fund. The expense ratio of the ETF is almost always typically about the same, if not less. Even at Vanguard, for example, you can buy like their total stock market fund in mutual fund flavor or ETF flavor. The ETF actually has a slightly smaller expense ratio by like 0.01%. So not dramatic, but still smaller nonetheless. And there's a few reasons why ETFs have less expenses. Generally speaking, actively managed strategies are more labor intensive to carry out. So managed mutual funds will have higher expense ratios. Passively managed, because again, remember, passively managed funds are a lot less work and resources for the fund company to carry out. So that right there, generally mutual funds can be passive or active, whereas ETFs are almost always passive. So that right there means they'll have lower fees. But like I said, even pound for pound, passive versus passive, Vanguard's US stock fund and mutual fund flavor has a slightly higher expense ratio than Vanguard's US stock market ETF. They're identical portfolios with identical holdings, yet the fee is ever so slightly smaller in the ETF. And that's simply because ETFs have less ongoing administration, and you'll see, and I'll touch on why in a moment. Just scanning comments quickly. Brian asks, am I a blue hen? Yes, I'm wearing a University of Delaware t-shirt. And Brian, you notice here, these feet I'm pointing at are UD's feet. Yes, I have a stuffed animal up on my shelf there. There you go. All right, I'll bring that back. Okay, moving on. Next comment, or next topic, trading. Now, this is a big difference, how mutual funds and ETFs are traded or bought and sold, if you will. Let's start with mutual funds. So when you buy or sell a mutual fund, you are buying or selling directly to and from the fund company. Like Vanguard, for example, you want to buy a Vanguard mutual fund, you call up or email or go on Vanguard's website, you're directly buying into the fund through Vanguard. When you get out of the fund, you're directly redeeming it back or selling out of, if you will, from Vanguard. You can also buy through a broker. Like lots of people have brokerage accounts where you can buy and sell other companies' mutual funds. For example, you can have a brokerage account at Schwab, and through that brokerage account, you can buy Vanguard mutual funds. Now, you're still ultimately buying that fund directly through Vanguard. It's just that Schwab is doing the work for you of kind of being a middle person to take your money that you deposit in your Schwab brokerage account. Schwab then turns around, directly goes to Vanguard, says, hey, Vanguard, buy $1,000 worth of XYZ for Andy. And so we can hold it in Andy's brokerage account here at Schwab. So you can buy and sell mutual funds through brokers, but ultimately they're still buying and selling them direct from the fund company, like Vanguard, like Janus, like T. Rowe Price, like whatever mutual fund company you want to fill in the blank with. When you buy and sell a mutual fund, you're only buying it at that day's closing value. Hold on a second. Yep. Okay. So I'll get to what I mean, why that's important. So regardless what time of the day you put your order in, trades are only executed at the 4 p.m. Eastern value of the fund. So 4 p.m. Eastern is when the stock market closes. And that's when funds will take a snapshot of the closing day, the day's closing prices, and value the fund. So whether you put in a buy order for a mutual fund at 9 a.m. Eastern, noon Eastern, or 3:30 Eastern, you only get your order transacted at the 4 p.m. Eastern price of that fund. And same thing when you sell. No matter what time in the day you put your sale order in, you'll only get it sold. It's basically as if you put that order in right at 4 o'clock Eastern exactly. Now, when you buy and sell a fund direct from a fund company, like if I'm buying a Vanguard fund straight from Vanguard, there's almost always no fee to buy or sell from that company. Some companies still have sales loads, like I said, but avoid them. There's no reason for them, in my opinion. So you can buy and sell direct from Vanguard with no fund or expenses. If you do happen to buy through a brokerage, like I said, the example of you have a brokerage account at Schwab, you want to buy a Vanguard mutual fund, you can buy that fund through your Schwab account, but Schwab will probably charge you to be the middle person to buy or sell that fund for you. So like for clients I manage money for, their accounts are at TD Ameritrade Institutional. I can buy and sell for them almost any mutual fund that they want from whatever fund company. Most funds will have a $31 trading fee for me or buy to sell for them in their TD brokerage account. So anyway, so just keep that in mind. If you're buying a mutual fund through a brokerage account, you may have a fee to do it. When you buy and sell exchange traded funds, things are very different. You do not buy and sell direct from the fund company. These ETFs trade like stocks. You buy and sell them through a broker, which in effect, that broker is buying and selling them direct from whatever exchange it trades on, like New York Stock Exchange, for example. The other huge difference here is ETFs, like stocks, you can buy and sell throughout the day. Trading hours are 9:30 a.m. to 4 p.m. Eastern, the U.S. stock market hours. If I put in an ETF trade at 9:35 Eastern, it will get executed almost instantaneously at 9:35 price. If I put it in at noon, it'll get executed at noon. If I put it in at 3 p.m., it'll get executed at 3 p.m. Whereas in mutual funds, again, no matter when in the day you put the order in, it only gets executed at the close of day price. So ETFs, like stocks, buy and sell throughout the day through brokers, through exchanges, whereas mutual funds, once a day, only direct from the fund company or indirectly through a broker who just kind of acts as the middle person for you. Now, whereas I said when you buy a mutual fund through a brokerage account, you'll likely have a trading fee. In the case of TD Ameritrade, it's $31 for clients I work with. When you buy and sell ETFs, because they trade like stocks, at this point there's almost most brokers don't charge any per trade fees to buy and sell stocks or ETFs. Whether it's E-Trade, Schwab, Fidelity, TD, none of them charge for basic buy and sells of stocks or ETFs. So you can, in most cases, buy ETFs and sell ETFs with no transaction cost. With mutual funds, if you go through a broker, you'll likely have a transaction cost, but not always. So that's trading. Right. How are they valued? This is why the end of day thing matters. So when you buy a mutual fund, it trades once a day at its daily NAV or net asset value, NAV. All that the NAV is just simply the fund takes every single thing it owns, all of its stocks, all of its bonds, all of its cash, adds it up, subtracts from that any liabilities it may have. That's its net asset value. Simply everything it owns minus everything it owes. That's its net equity or net asset value. You, as a shareholder or mutual fund holder in that pool, you own, like I said before, a prorated slice of that net asset value. So every day, your shares, your interest in that fund, have a once a day quote of net asset value. And again, that net asset value is determined as of closing day prices, which is 4 p.m. Eastern, when the stock market's closed. So one price per day, it's a net asset value, no more, no less. When you buy or sell an ETF, because they trade like stocks and they trade throughout the course of the trading day, the price moves around throughout the day. You don't buy or sell them directly at the net asset value. You buy them at whatever the market price happens to be at the time you put your order in, or at the time your order gets executed, I should say. Now, generally speaking, the price at which you buy and sell will be very close to the net asset value, or what the hypothetical net asset value would be at that point in time during the day. But it's usually not exact. It's going to be a fraction of a percent off. Could be higher, could be lower. Also, because it trades through brokers, through exchanges, or something called the bid-ask spread. Generally speaking, the price at which you buy something will be slightly higher than the price at which you sell it. And that's how the intermediaries or brokers make money. They clip a small little amount. They buy high, sell low. Or did I say that backwards? They buy low, sell high, and they net the difference. And we, the shareholders, are the ones who pay that difference. I'll leave that there for now. Now, one of the concerns about, and this is one of the more commonly held criticisms of ETFs, is the portfolio of things the ETF owns is what it is. That's what its net asset value would be. But that's not the price at which you actually buy and sell it. Because like I said, it can move throughout the day and there's going to be a little deviation from net asset value. So people who try to discredit ETFs will say, well, that deviation, that dispersion between the price at which you buy and sell and the net asset value could be large. And it can be. Generally speaking, it's not, especially for larger, big, well-traded, lots of participants, a lot of buyers and sellers, ETFs, like the big funds from Vanguard and whatever. There's plenty of liquidity, plenty of transactions. There's negligible difference in the price at which you buy and sell from the net asset value, so that you don't have to worry about like losing out a lot of money by buying and selling ETFs versus mutual funds, where you always get the net asset value when you buy and sell. Now, this gets really technical. I won't get too deep into it, but there's a reason for that. There's a reason why ETF prices stay close to NAV, and it's the way ETFs are created. And this gets funky, and I'll try to keep it high level, but long story short, there's large intermediaries, typically the big Wall Street global investment banks, act as what's called authorized participants. They're the ones who actually create units of ETFs, if you will, and they're the ones who then put them in the market and buy and sell them. there's an arbitrage opportunity where if the price at which an ETF is trading in the market deviates far from the net asset value, these authorized participants can step in, buy it or sell it, and they reserve the right to liquidate. They're the ones who directly interface with the ETF fund company. They can take these ETF shares they have from the market, they can turn them in to the fund company. The fund company in return gives them back the shares that belie, that create that basket of securities that ETF is supposed to track. And so there's this arbitrage. Because the authorized participants can turn in ETFs and get the actual underlying shares back, the price of these ETFs can't deviate too far from the actual underlying net asset value of all the stuff the ETF owns, because there's this opportunity of easy money to be made. So if and when prices deviate too far from net asset value, authorized participants step in, kind of whittle away that price difference such that ETFs end up trading right near their net asset values. I'll stop it there. That's super technical. The whole process around which how ETFs are created and redeemed is clunky and funky and very different from mutual funds. But it's important for me to speak of it because it helps explain why ETFs typically don't have drastic swings in price from NAV. And it also helps explain why they're more tax efficient, which I'll touch on. And that's another big part of ETFs. All right, moving on. How are mutual funds versus ETFs taxed? So just like any asset, like a stock, a bond, a property, a house, whatever, there's a capital gain whenever you sell it. To the extent you sell it for more than what you paid, you have a capital gain. If you sell it for less than what you paid, you have a capital loss, right? Straightforward so far, right? The fund also owns or passes through dividends and interest of all the positions that it owns, and you're taxed on those dividends and interest in the year you receive them. So mutual funds are created under regulations that say everything that pot of money, a mutual fund is just a big pot of money, mind you, that invests in stocks and bonds and owns them in the pot. Everything that pot owns, all the economics and all the income and dividends and stuff generated by the investments within that pot need to be passed on to you, the mutual fund share owner. So if a mutual fund owns 500 stocks and those stocks pay some dividends, well, guess what? The mutual fund has to pass those dividends on to you. Just like if you were to own the stock yourself and the stock pays dividends, you get taxed on dividends in the year you get them. Owning stocks indirectly by way of a mutual fund is the same thing. As the stocks in that fund pay dividends, that fund pays those dividends on, passes them on to you. So you're still taxed on them in the year you get them. So no surprise there. Here's where people get caught off guard and often surprised. Now, you all know, as we just touched on, when you sell something you own, you may have a gain or a loss, taxable gain or a tax reducing loss, right? Everyone got that. Now, when you own a mutual fund, especially actively managed ones, the fund and the fund managers are buying and selling things within that fund throughout the course of the year. And remember, like I said, all the activity, all the transactions within the fund have to get passed on to you, the shareholder, the mutual fund shareholder. So even though you own your fund for the whole year, you don't sell any of it, the fund itself is selling securities throughout the year. To the extent those securities are generating gains, those gains are getting passed on to you, and you have to pay tax on those gains. Even though you didn't actually get use of the money, typically those gains are reinvested in other stocks within the fund. It's still a taxable event for you. I'm sure a lot of you who own mutual funds, especially actively managed mutual funds, in regular brokerage account, you get this little sort of unwanted surprise in December when the fund gives you what's called a capital gain distribution. It says, guess what? We sold $1,000 worth of gains within the fund in the year. Now you have to pay tax on $1,000 that year, even though you never actually got the money and you never actually sold your fund. They still pass on the gains to you. So it's called the capital gains distribution. There's more of those with actively managed funds, again, where there's a lot of buying and selling within the fund, more so than passively managed funds, where it's typically they kind of buy the stocks and just let them sit there. So long as the index doesn't change, the fund doesn't need to swap out, typically doesn't need to swap out positions. Now, where it gets complicated is when there's redemptions. Even if you don't redeem or sell out of your funds, there may be other people who do, other holders of that mutual fund. And if the fund company doesn't have enough cash in the pot of money in the fund to pay out the redemption to the people who sold out of their funds, well, guess what? The portfolio managers have to sell out of some of their securities, some of their stocks within the pot, to generate cash, to distribute that cash out to the people who went out of the fund. Well, that's a taxable, potentially taxable event, especially if they're selling things within the fund at a gain. So there's another example of why you may get some capital gains passed on to you because other people redeemed. Even if you don't, other shareholders' redemptions may stuff you with some unwanted capital gain distributions in a mutual fund. So that's why mutual funds are said to generally not be that tax efficient when held in regular taxable brokerage accounts because of these capital gain distributions, which you have no control over. You just kind of get stuffed with that income at the end of the year. Exchange traded funds, very different. Well, in some ways the same, in other ways very different. So when you sell an exchange traded fund, just like any other asset, just like a mutual fund, when you sell it at a gain, you pay tax on the gain. If you sell it at a loss, you have a tax reducing loss. ETFs also may pass through or have to pass through dividends and interest. So if you own an S&P 500 ETF, guess what? Some of those stocks are going to pay dividends. That ETF will pass the dividends on to you. Those dividends are taxable to you in the year you get them. So far, the same as mutual funds. The big difference from mutual funds is that ETFs almost always or rarely ever pass on any capital gain distributions to you. So you don't have those unwanted surprises in December. And that's a function of a few things. One, because ETFs are generally passively managed. There's not a lot of active trading, buying and selling. But more importantly, and this is what drives it, is because of the way ETFs are created and redeemed. Again, this is hairy and technical, so I won't get too deep into it. But you don't buy and sell ETFs direct from the fund company. You buy and sell from the market, right? So if you want to redeem, you want to sell out your ETF, you just simply go to your broker, click sell, and the order gets executed almost instantaneously. You don't have to go to the fund company like Vanguard and say, hey, give me back my $1,000 for my ETF, right? In which case Vanguard may need to sell some shares to generate a capital gain to give you back cash. No, it doesn't work like that. Now, it's the authorized participants, the big Wall Street banks that facilitate the creation and redemptions of large blocks of ETFs. They're the ones who actually subscribe and redeem direct from the fund company. But here's where the magic comes in with this tax savings thing. When an authorized participant is redeeming a block of ETFs out of the market to give them back to the fund company, they don't get cash back from the fund company. No, instead they give back the ETFs, the shares of ETFs. In return, the fund company gives them back the securities that make up that ETF. That's a non-taxable transfer of one type of security for another. So that's why you might not be following this, and it's hard to discuss without having a whole separate explanation about these authorized participants and stuff. But that's the tax magic behind why ETFs don't have these unwanted end-of-year taxable capital gain distributions, because of the way in which authorized participants create and redeem ETFs from the market. I'll leave it there for now. I worked at one of the places I worked is BNP Paribas, which is France's largest bank. It's a global investment bank. One of the roles I was in was a group that was an authorized participant to a particular fund company. So this was better part of 10 years ago. I'm a little rusty on it, but I saw the process by which ETFs are created, redeemed, and all the kind of magic that goes into it. It's really, really cool process. But that's what makes ETF special from a tax perspective. And finally, last thing I want to mention is transparency. So mutual funds, by regulation, have to report every single line item of holdings, every stock and bond they own, only once a quarter. They can report more frequently, but they don't have to. Generally, it's once a quarter, especially for the actively managed ones, where the managers don't want to give away their secret sauce or let people kind of reverse engineer what the manager's secret sauce may be. So they don't want the whole world knowing every single position they own many times. So they'll just only report once a quarter when they have to, which means you as a mutual fund holder, you're kind of flying blind intra-quarter because you don't exactly know what that fund holds. You may have a guess, you may know some of it, but you're not necessarily going to know the entirety of the investments until only once a quarter when they have to report it. ETFs, if it's actively traded, they have to report daily. There's technical reasons for that, and it goes back to the whole authorized participant thing and the fact that the market needs to know what exactly the fund has because of the way in which the price it trades at needs to stay close to NAV, the market and the authorized participants need to keep it honest. They need to know what exactly it has so they can figure out what the NAV is, so they can make sure the price stays around it. Fairly technical, but the point is actively traded ETFs need to report their holdings daily, whereas mutual funds are only once a quarter. Passively managed ETFs, I don't think they have to report daily. I think they're still required to do at least quarterly. But for passive stuff, you know what it is. Like if it's a S&P index tracking ETF, you know the stocks that are in it. It's the S&P 500. There's no magic to figure out what's in it. One other comment I wanted to make that I did not put in a slide, and I don't know why, is when you do buy them, like, do you have to buy whole shares or not? One of the benefits of mutual funds is no, you can buy mutual funds by the dollar amount, not the whole share amount. So if you have $1,000, you want to invest in a mutual fund, you can call Vanguard and be like, hey, I got $1,000. I want to put it into fund ABCD. If that fund's trading at $333.17, you're going to get like whatever, three point something shares or 2 point something shares. You don't have to buy whole shares. You can definitely buy fractional shares by the exact dollar amount. ETFs, depending on the broker through which you buy and sell them, you likely have to buy them in whole shares only. There's some exceptions. Some brokers like Betterment, Schwab perhaps, do allow what's called fractional trading. You can buy like 1.32 shares of an ETF, but many brokers will make you buy only 1 share or 2 share or 3 shares, not partial shares. The other exception is if you have a dividend reinvestment set up at the broker, then that broker will almost certainly let you buy fractional shares. As you get the dividend thrown off from the ETF, that broker will let you buy, 0.17 shares or however much one dividend, the dividend payment buys. So in that sense, maybe mutual funds are a little more conducive to, especially to like smaller size dollar amounts where you can put in $500 and get exactly $500 in mutual fund. ETFs, right? If ETF is trading at $300, you only have $500 to invest, and you can only buy whole shares. That means you can only buy 1 share at $300, right? You got to wait until you get another $100 or the share price drops or whatever. So that's a possible sort of drawback of ETFs there. Let me leave it there. I don't have slides for it, but I have some comments, kind of thoughts about why ETFs or mutual funds make sense in IRA or Roth IRA or regular brokerage account. I'll say it now, actually. So as you can probably tell, and I think I already said it, when you own your investments in a regular taxable brokerage account, passively managed ETFs are generally going to be more tax efficient because they don't pass through these capital gain distributions like actively managed mutual funds do. Now, there are mutual funds that are tax managed or tax efficiently managed or whatever, where the fund company is conscious of trying to keep the taxable impacts of the fund low, in which case then those are, generally okay to hold in regular brokerage accounts. But normal actively managed mutual funds will throw off capital gain distributions throughout the year, and that's taxable to you, which is kind of annoying. ETFs don't do that. So in regular brokerage accounts, ETFs generally better. IRAs, Roth IRAs. Some people, and this is opinion, and I have my own opinion, some people feel like, no, it should always be mutual funds because you can buy partial shares, whatever. I don't see the benefit. I personally and professionally with my clients use ETFs in regular brokerage accounts and Roth IRAs and IRAs. Now, partly that's because I'm a passive index-based investment guy. My 20 years prior to starting my business was all in institutional banking and investment and risk management. And I've seen and worked with some of the best and brightest fund managers, mutual fund managers, private equity managers, hedge fund managers. And I just don't see active management. In the vast majority of cases, for most people, a basic, low-cost, few-fund ETF portfolio is all most people need, right? It doesn't mean there's not lots of people trying to sell stories and have impressive pitches and pedigrees as to why their active strategy is going to do well. And science and academia says this and sounds good on paper, but more times than not, actively managed funds, especially equity funds, don't end up doing any better, especially net of the higher fees, than just low-cost passive index funds. So anyway, that's why I use ETFs, whether it's Roth IRA, regular brokerage, it doesn't matter. I don't frankly see any real benefit to mutual funds. for all the reasons I mentioned. They trade easily. There's no fee to buy and sell them. That means you can rebalance them easily. ETFs, whereas mutual funds, you may have to pay a fee every time you want to add or take away from your position. The possible deviation in price from NAV isn't that much of a concern for me, and I don't think it should be for most people, especially since I use large, well-known, very liquid, lots of buyer and seller ETFs, that it's negligible. And since I'm a buy and hold investor for myself and my clients, the little bit of bid-ask spread that we have to put up with is negligible over the course of decades, which is the investment horizon here. So anyway, ETFs I think are plenty good in any account type for the vast majority of people, for the vast majority of risk tolerances. You can find any flavor of ETF you want, stock, bond, etc. Not to say mutual funds are bad by any means. I don't see a lot of reasons where they really trump ETFs, except if there's some special active strategy you want, then sure. Anytime you start talking about active strategies, you almost always are going to have to find it in mutual fund form because ETF's probably not going to have it, in which case, yes, you need a mutual fund. But otherwise, for passive index-based investing, I really don't see any compelling reason why you can't use ETFs or why mutual funds would be that much better. Let me put it that way, if even better at all. All right, now I'm done. That's all I wanted to say about that. Let me go to questions. All right, let me take off screen share. I will bring it back if and when necessary. Starting at the top here. Okay. So front end and back end loads, yes, touched on that. Load is just simply a commission that you pay when you buy or sell the fund. When you buy, it's called the front end. When you sell, it's called the back end load. As I mentioned, thankfully, loaded funds are much less prevalent than they were. Doesn't mean they're not out there. You should probably avoid them because, again, I don't see any mutual fund whose strategy is so awesome or necessary that it can justify paying a multi-% load, or any load for that matter. And I'll go ahead and bash the one I saw I didn't like because I think it's worth bashing. So I came across someone who has accounts with David Lerner is the name of the broker. And David Lerner has their own proprietary mutual funds by a fund company called Spirit of America. And these funds were garbage. I looked at their returns relative to their peers. They were garbage. A lot of the reason is because the funds have a 1.5%, give or take, expense ratio, which is insanely high. Actively managed mutual fund expense ratios are 0.5% to 1%. 1% is high, unless it's some crazy esoteric strategy, then maybe it's over 1. But these David Lerner funds, Spirit of America funds, weren't anything exotic. It was basic, like large cap equity funds. They're charging 1.5% ongoing expense ratio, which is highway robbery. On top of that, there's a 5% upfront sales load, which is absolutely ridiculous. So that's just the brokerage industry running wild and milking people, selling subpar investments at really high fees and commissions simply because they can. It's not illegal. They're allowed to. It's just disgusting that their products like that exist when there's so many lower cost and better, cheaper alternatives. There's no reason to buy, in my opinion, funds like that. So anyway, I'll get off my soapbox now. What's this? David Fultz. Why is it that you can do a mutual fund to ETF exchange, but not vice versa? Also, isn't the lower basis point expense ratio of ETFs negated by trading costs because of the buy and sell spread? Yeah, great question. So 2 questions. One is, it's only Vanguard, to my knowledge, David Fultz, where you can swap out a mutual fund to an ETF. So the Vanguard has this patented process where ETFs are technically just a share class within their mutual fund offering. Therefore, you can do an in-kind tax-free transfer from the Vanguard like VTSAX mutual fund to its ETF counterpart, the VTI. It's the exact same portfolio. One's a mutual fund flavor, one's ETF. You can swap out the mutual fund to the ETF. It's a tax-free transfer of position type, but you can't go from ETF to mutual fund. I honestly don't know why you can't go the other way around, but you can't. So to your question about, yes, the lower ongoing expense ratio of ETFs, is it negated by the trading costs of buy and sell spread? Sure, perhaps, especially the more you trade in and out of ETFs. Yes, maybe this adds up, but you can minimize that. You can reduce that. Could you completely negate it to the point that it even inclusive of bid-ask spreads, it more than offsets the difference in expense ratio? Possibly. Again, buying and holding, not trading too frequently, trading in ETFs that are really large, really liquid, have deep deep number of market participants and authorized participants. Those will all lead to lower, real tiny kind of razor thin bid-ask spreads. So not that huge of a concern. It also depends, at least for me, from a advisor managing other people's money. Every time I buy and sell a mutual fund, it's $31 that the person has to pay. I'd like to avoid that fee. There's no such trading fee to buy and sell an ETF. Yes, there's a small bid-ask spread, but I think generally speaking, over time, that bid-ask spread difference, especially with my rebalancing, should be better for the client than them having to pay $31 every time I buy or sell more or less of a mutual fund. Yeah, good question, David Foltz. Jun Wang, is the fee higher if you buy from, say, Raymond James for Vanguard mutual fund ETF as compared to buying from Vanguard? So yeah, it's likely, but depends what fee you're talking about. So the built-in expense ratio of the funds should be the same, or will be the same, whether you buy a Vanguard mutual fund or Vanguard ETF through a Raymond James brokerage account or direct from Vanguard. The fund expense ratios will be the same, should be the same, will be the same. Now, Raymond James may charge you a trading fee, a per transaction fee to buy and sell that Vanguard fund. Like at TD, for clients I work with, accounts at TD, there is a $31 fee anytime someone wants me to buy or sell them a Vanguard mutual fund in their TD brokerage account. Now, if you were to buy that same Vanguard mutual fund direct from Vanguard, there's no fee for the client to do that. ETFs, same, it doesn't matter. The expense ratio is the same, like I said, and there's no trading fee for me to buy and sell an ETF through my TD brokerage account for clients, or through clients' TD brokerage accounts, or to buy that direct to Vanguard. So ETFs doesn't matter. Mutual funds probably matters, but you'd have to ask Raymond James, specifically ask the question, are there any trading fees or commissions for me to buy or sell Vanguard mutual funds or ETFs? If yes, how much? And ask them just to confirm, are there different expense ratios to buy the fund through you versus Vanguard? Now, the answer should be no. The reason why I thought it could differ is like this is off topic, but when you own a variable annuity and you own Vanguard funds within that annuity, the expense ratios will be higher to own the fund through the annuity wrapper than it will be if you own the fund outright through Vanguard or through a normal brokerage account. June, good question. Kenan, the challenge with mutual funds is that you could have capital gains even though the price of the mutual fund NAV might be lower than the buy NAV. Let me digest this. Do you mean through capital gain distributions, Kenan, or do you just mean like when you buy or sell? Capital gains, even the price of the mutual fund NAV may be lower than the buy NAV. Yeah, I think that's what you mean. So right, if you buy it at 100 and you later sell it at 90, or let's say it's trading at 90, it may look like on the surface you don't have any capital gains, but because they pass through gains throughout the year, sure, you can still have taxable gains even though you don't sell it and even though the price is actually lower than where you bought it. June Wang, all things considered, which one do you recommend? I can't recommend anything through a public forum like Facebook. Hopefully through my commentary and what I said and how I implement portfolios, I think you know my thoughts, but this is a reason why I rarely wade into discussing anything about investments, because there's a line that can't be crossed. I can't come close to giving anything that looks or smells like investment related advice through a public forum. So I kind of answer that, June, but for what it's worth, I use almost exclusively ETFs. Doesn't mean it's right or wrong. Different people have different opinions. Your what's best for you may be different than what's best for me or my clients, but I generally use ETFs exclusively. Are underlying capital gains during the year for mutual funds considered ordinary income, or does that depend on exactly what shares the fund sells? Yes, the latter. It depends on what shares the fund sells. In my experience, it's usually long-term capital gains. I think the fund managers are pretty good about trying to sell stuff that's long-term as opposed to short-term, but in theory, yes, they can be capital gains that are short-term. It's passed through just the same. If the fund manager buys the stock today, sells it in a month, and it's a short-term gain, that gain will get passed through to you as a short-term gain. Ooh, qualified versus ordinary dividends. It's kind of technical, but basically qualified dividends are dividends that are paid by U.S. companies. There's some exceptions, but assume U.S. companies, and you own the stock more than, I think it's a 60-day window around the stock dividend date or X date. You have to kind of own it 30 days before and 30 days after, roughly. Anyway, it's easier way to think about it. If it's a U.S. stock and you own it long term, chances are its dividends are going to be qualified. And if it's qualified, the dividend will be taxed at the reduced long-term capital gain rate of 0, 15, or 20%. If it's not a qualified dividend, it'll be taxed as ordinary income, which is whatever your tax rates are, 10, 12, 22, 24, 32, 35%. That's the difference. And same thing with mutual funds. The mutual fund will keep track of, is it an ordinary or is it a regular dividend, and or I'm sorry, qualified or ordinary, and it'll pass that through to you through its 1099 reporting at the end of the year. It'll tell you how many dividends were ordinary versus qualified, June. So similar question. So ETFs would have both qualified and non-qualified dividends. Would the proportion be different from a mutual fund? No, I don't think so. Whether it's ETF or mutual fund flavor, if you own an S&P 500 index fund, they should have the same split of qualified versus non-qualified, or qualified versus ordinary dividends. Ooh, closed-end funds. Any value in using closed-end funds? The plot thickens. So it depends. I guess first question is, what is a closed-end fund? A closed-end fund, kind of the love child of mutual funds and ETFs almost. That's the best way to think about it. Now, there's no the big difference, a few differences. The big differences is because they can't be directly redeemed, there's no redemption risk. So you buy and sell them from the market, not directly from the fund company. That means the funds can invest in higher risk, lower liquidity stuff, things that it may take them a while to get out of. So the upside is higher risk, higher return, right? That higher risk stuff allows them to buy things that pay higher coupons, higher dividends, but potentially higher risk of price loss in those securities. They can also use leverage. That's often how closed-end funds will kind of ratchet up their returns and their dividends, as they will borrow money to buy more of the stuff in which they invest. And leverage works really well when things are doing good, but it works against you when things are doing bad. It levers the good better. It levers the bad worse. The price at which closed-end funds get bought and sold on the exchange can vary quite dramatically from the underlying net asset values. Recall I said with ETFs, the prices are almost always right around net asset value, fraction of a percent different typically. Closed-end funds could quite commonly have upwards of like 10% difference in price from the price at which you buy and sell versus the underlying NAV. There's a lot of weird phenomena that explain why. Sometimes they trade at premium, sometimes at discounts, but the point is that there can be meaningful difference. So is there value? Perhaps. Generally speaking, closed-end funds could throw off higher dividends and interest, right? The downside is that they can be higher risk because they're generally higher risk securities to start with that they hold, and they're often employ leverage, which can backfire. Leverage works well when things go up. Leverage works really bad when things go down. So I'll leave that there. There's a group on Facebook and a guy who's all about closed-end funds and touts how he makes so much money and they got 10% yields on them, and some of them do. They do have 10% yields, but they're higher risk things. They work well until they don't. If and when downturns happens, a lot of closed-end funds are going to take their lumps, more so than less risky investments. Marjorie, are passive mutual funds more tax efficient? Probably not as efficient as ETFs, but still better than actively managed funds. Exactly. Passive will always be more tax efficient than active, just simply because there's less churning. There's less buying and selling of positions within the fund, within that pot of money. So yes. Is it worth it to sell mutual funds to convert to the equivalent ETF? I can't say if it's worth it. I mean, it's like was it David Foltz asked? It is possible with Vanguard. You can do a like kind no tax impact exchange from the mutual fund to the corresponding ETF, to the extent that mutual fund has an ETF version. Not all mutual funds at Vanguard have ETFs, but a lot do. can't say if it's worth it. It depends why you want out of the mutual fund into the ETF in the first place. Okay. Never mind. Sorry. Buy one share of any ETF, hold for more than 1 year, and sell one share of the same ETF with a gain. Taxes are assessed only on the difference of dollar amount between buy and sell price, correct? Yes, that's correct. And along the way, during that year, any dividends or interest that were paid will be taxable to you in the year you receive them or the year they were paid. But that's correct. You buy one share of ETF at $10, you sell it a year later for 15, you have a $5 capital gain. If you hold it more than a year, it's a long-term capital gain. If you hold it a year or less, it's a short-term capital gain. Plus, again, the dividends and interest paid throughout the year, you're taxed on those. Okay, looks like the last question we got here. David Foltz, isn't the ETF structure more beneficial to a company such as Vanguard because they can have someone purchasing their ETF through another company and it's costing them less money because of less expenses? Yes, all else equal, that's true. And that's also part of the reason why pound for pound ETFs have lower expense ratios in mutual funds, because there's simply less work in them transacting this. Like when you, as I said, when you buy a mutual fund from Vanguard, someone at Vanguard has to take that order. They have to do the subscription paperwork. They have to file whatever report, send you your shares. That's a lot more work than an ETF. When you buy and sell a Vanguard ETF, Vanguard's not directly involved at that point. You're buying it through your broker, E-Trade, Fidelity, Schwab, whoever. You're buying it through them. So Vanguard's work and process is when they interact with the authorized participant. They don't create one and redeem one ETF at a time. They create and redeem large baskets, large blocks of ETFs to and from these authorized participants in the market, the big investment banks. So it's a lot less process and resources for Vanguard to create and administer an ETF than it is a mutual fund of the exact same portfolio, which is, again, part of the reason why ETFs have slightly lower expense ratios. Okay, looks like that is it for the comments. So thank you all for joining. Have a great week. Don't forget, next week is another mailbag. Ask Andy anything. If you have questions, send them to me ahead of time, Facebook chat, email, just reply in one of the Facebook comments in the group, whatever. And next week, again, will be the 1 year anniversary, 1 year birthday edition of Taxes and Retirement Live. I'll try to come up with something cool for that. All right, that's it. Take care. Have a good week.